Welcome to this explainer. Now, I know exactly what you might be thinking. Partnership accounting sounds like a pretty dry, technical topic, right? But hold on, because we're going to peel back the layers of these ledger entries together and reveal what this subject actually is: a fascinating, highly structured framework for preserving absolute fairness in business. So, before we even look at a single number, we really have to ask the ultimate question about human behavior in business. How in the world do you stop money from completely ruining a great partnership? Because let's be honest, when two or more people go into business together, it's all optimism, big ideas, and handshakes at first. But when real profits roll in, or worse, when unexpected losses start piling up, how do you make sure everyone feels they're being treated fairly? The answer to that human conflict, it turns out, lives right inside the ledger. To get to the bottom of that, here's our roadmap for today. We're going to map out the rulebook baseline, separate our capital and current accounts, navigate partner loans, solve the guaranteed profit puzzle, and finally, look at how the appropriation account brings it all together. All right, part 1, the rulebook baseline. Let's see what happens when you just jump in and start working with someone without a formal financial agreement. According to Section 24 of the Partnership Act of 1890, the default rules are, honestly, pretty brutal. If your agreement is silent, the law steps in with a really heavy hand. Profit and loss? Shared equally. Period. Partner salaries? Absolutely none. So picture this. You're grinding out 80 hours a week, and your partner is working maybe 10 because they're out finding themselves. Guess what? You are still splitting those profits 50-50. Plus, there is zero interest paid on the capital you invested and no interest charged on what you draw out. It's a massive reality check that practically forces partners to sit down and actually draft a customized agreement. But there is one very specific, very important number carved out in that 1890 Act: 5%. Interestingly enough, the Act specifies that if a partner loans the business money, meaning they advance cash above and beyond their initial capital investment, they get a default 5% interest rate per year on that loan. The law clearly recognizes that acting as a bank for the business is a fundamentally different relationship from just being an owner. Now, a quick caveat depending on your specific jurisdiction or syllabus. For example, if you're looking at the CBSE curriculum, which the Commerce Ninjas source notes, that default interest rate for partner loans is actually 6%. So, always know your local rules. But the core principle here remains exactly the same. Loaning money to the partnership earns you a guaranteed return, even if you don't have a written contract. Moving on to part 2, capital versus current accounts. Let's take a look at how the ledger organizes a partner's money to maintain peace. I like to think of the capital account as the untouchable vault. This reflects the fixed initial investment you made to get the business off the ground, and under a fixed capital system, it stays totally stable year by year. On the flip side, we have your wallet, which is the current account. This captures the everyday, ongoing financial relationship. It's where profits, salaries, and interest go in, and it's where cash drawings and interest on those drawings come out. Keeping the vault and the wallet separate like this ensures you never confuse your core ownership stake with your yearly earnings. So the absolutely crucial thing to understand here is what happens when that wallet runs empty. A debit balance in a partner's current account is a negative financial state. It literally means the partner actually owes the firm money, rather than the firm owing them. If someone treats the business like their own personal ATM, just pulling out cash whenever they want, their wallet hits a debit balance. From a fairness perspective, this is a blaring financial warning sign that someone is taking way more than they're giving. The 2011 SEC accounting marking scheme from the University of Malta lays this out brilliantly. It notes that a debit balance will be the result of drawings in excess of the profits to which the partner may be entitled, or if losses have been made. Basically, it is undeniable proof that a partner took out more than their fair share of the earned profits. It's literally the ledger waving a red flag and saying, hey, you are eating into the business's lifeblood right now. All right, part 3, navigating partner loans. What exactly happens when a partner has to step up and act as a lender to keep the lights on? This brings up a massive point of tension in pretty much any partnership. Think about it. If a partner loans the firm money, do they still get to collect their interest at the end of the year if the business makes absolutely zero profit or even suffers a loss? Does the lending partner get paid while everyone else suffers? The answer is a resounding yes. And to understand why, we have to look at the difference between a charge against profit and an appropriation of profit. A charge against profit, like interest on a partner's loan, is an external expense. You literally have to pay it regardless of whether the business makes a profit or a loss. An appropriation of profit, however, like partners' salaries or general profit sharing, is an internal distribution. It only happens if the business actually succeeds and makes a profit. You just can't appropriate what isn't there. Because interest on a partner's loan is a guaranteed expense, it bypasses that appropriation account completely. It gets debited straight to the main profit and loss account, exactly like your electricity bill or a supplier invoice would be. This incredibly strict accounting treatment protects the lending partner, ensuring they get compensated for taking on that financial risk before any ownership profits are even discussed.
Moving to part 4, the guaranteed profit puzzle. Let's say you need to convince a highly sought-after expert to join your unproven partnership. How do you do it?
Well, you offer them a guaranteed minimum profit share. And basic college accounting principles give us the exact fair steps to record this. Step 1, you pay the guaranteed partner first. You debit the appropriation account with the guaranteed amount and credit that partner's current account directly. Then, step 2, you take whatever profits are left over and you share them among the other partners based on their previously agreed ratios. But here is where the fairness framework gets truly tested. What happens when the actual earned share of profit amounts to less than the amount you guaranteed? The critical rule here is that the other guaranteeing partners bear the shortfall. If the business underperforms, the guaranteed partner still gets their full promised cut. The original partners literally have to surrender their own profits to make that guaranteed partner whole. It is a powerful, binding transfer of risk. Finally, part 5, the appropriation account. This is where all these rules and guarantees perfectly come together at the end of the year. The profit and loss appropriation account is essentially the grand equalizer of the partnership. It takes the net profit from the main P&L and systematically applies the partnership agreement. It adds back interest charged on partner drawings, then subtracts interest on capital, subtracts partner salaries, and subtracts any of those guaranteed profit allocations we just talked about. What you are left with at the very bottom is the final divisible profit or loss. It ensures everyone gets exactly what they agreed upon in the exact right order. We can see this beautifully in action through Donald's ledger from the Malta SEC marking scheme. Think back to our vault and wallet concept. Donald's $60,000 capital vault remains completely untouched by the daily grind. Meanwhile, his current account wallet is busy processing his complex everyday reality. It takes in his $15,000 salary, his $2,750 interest on capital, and his $11,000 profit share. All of this perfectly offsets his $16,500 in cash drawings, leaving him with a healthy positive balance. The system just works, and everyone knows exactly where they stand. As we wrap up this explainer, I want to leave you with one final critical thought. These accounting rules, they aren't just dry math for a textbook. They act as the impartial judge of fairness when human emotions run high and real money is on the line. So take a look at your own business relationships and ask yourself, if the ledger is the ultimate impartial judge, are your partnership agreements truly built to survive a financial loss? Thank you so much for joining me, and keep seeking those clear explanations.